Yes, good morning, ladies and gentlemen, and welcome to today's webinar where we are going to have a look at the quite unpopular investment universe in the past years, except of Japan. Asians stock markets are undergoing major changes. China's markets are struggling due to the government control, while India's more demographic path is boosting the stock market, and Japan's stock market had also a stellar performance. Today we will be discussing the Asian market as a whole. We won't just focus on individual markets, but also try to understand the kind of bigger picture. So what are the current prospects for these markets? Where should investors jump in during upswings and might pull out during downturns? So we will try and figure out whether it's wiser, for example, to invest in cheaper stocks like in China now, while selling more expensive markets like India or Japan. We will also try and discuss when it makes sense to invest in a more kind of country-specific fund, like in Japan equity fund or Indian equity fund, or should you go for a kind of Asian Pacific equity fund, for example. So we should not waste much time, and I would ask you to start with your pitch, Thomas, from Ofi Asset Management. The stage is yours.
Thank you very much, Paul. Hi all. I'm very pleased to meet you all to talk about Japan and Japan equities to be accurate. We are here today because Japan has its best times since the 90s. So if we want to have a look on the financial markets, we could see that year on year, the PIX is up by 33%, while the S&P 500 is just up by 28%. And the MSCI World is up by 25% year on year. So what really happened this last 3 decades in Japan? A few reasons for this expected economic rebound. At first, we have seen the reopening of the domestic economy after COVID, the favorable currency, the current economic boost, even if we have seen a GDP growth pretty flat last year. And last but not least, the corporate governance reforms implemented these last years. They start to be efficient. They are named Abenomics. I'm sure you have heard about them. Japan is an excellent alternative to benefit.
Thomas, just one second. Just one second. I can hear you. So there's, I think, one need to unmute or mute themselves. That would be great because I can hear you like twice.
Okay.
Or am I wrong? No, I think now it's working better. Yeah. Yeah. Yeah, it's better now.
It's better now. Okay.
Yeah.
Good. Perfect. So maybe we could share our slides, our pitch to show you a few figures in terms of economic situation first, before introducing our strategy and our way of investing in the Japan economy. So I told you about, I will try to flip the slide. Good. So here is a few figures about the economic momentum in Japan, about growth, about inflation. So I was talking about an economic momentum over there, thanks to the reopening of the domestic economy after COVID, the favorable currency. I'll be back on this topic because the yen has been depreciated, the current economic boost, and the corporate governance reforms in order to make Japanese stocks more profitable, more attractive. Just about the economic point of view, I said it was a momentum. Even if the GDP growth was flat last year, we see that we have new drivers for the Japan's economic dynamism with domestic drivers based on household consumption and business investments. But we have seen also an increase in consumption, largely explained by the use of the surplus savings accumulated during the COVID crisis, they start to be efficient to support household consumption. But there is more to come. Valuations are very attractive over there, especially versus the US ones. We can see also that foreign investors are back. Capital inflows in the Japanese stock markets are at their peak for the last 10 years. And we have seen also that these last 3 years, the yen has been depreciated by 30% versus the US dollar. You can see it on the right. So as you know, the Japanese economy is driven by exports because it increases corporate revenues and it also supports equity markets. It has been the main driver of the Japan performances these last 3 years. And other great success you could see on the right is that after decades of trying, the country is poised to exit from deflation, with the consumer prices up by 2.6% year on year in February. It's very close to the objective of the Bank of Japan. After years of deflation, it's a huge win over there. And moreover, on the figure on the left, you could see that thanks to the Shinto negotiations, which are the labor force negotiations, wages have increased by 4% in 2023, which is the highest growth rate for the last 30 years. So the outlook for consumption is expected to improve on the back of wage increases and fiscal support from the government. I could say that on the corporate side, the recovery in investment can be explained by very high order books, but above all, by the fact that orders can finally go in production thanks to the end of supply chain disruptions in Asia, to which Japanese companies are particularly sensitive. And other great factor for this economic momentum in Japan is tourism, which has finally rebounded as health constraints disappear. So Japan welcomed around 3 million visitors in January, which is a record year for tourism. And the government anticipates a record year in 2024 as well. So here is an overview of the Japanese situation on an economic point of view, about Japan equities and about our approach, what we do at OFI Invest to benefit from this economic boost. We have, this identification ID card, to show you our proposal, our philosophy, our approach, and our process. The fact is that our approach is a cautious approach with a low sectoral bias and with a low tracking error. Our objective is to monitor and manage the risk very well. In the meantime, we are looking for an exposure to the Japanese market with a cautious approach, as I said, but providing a regular alpha. We need to make that a very consistent philosophy, which is a pragmatic approach to investment, which is known as GARP, meaning growth at reasonable price. So how we do that? We do that thanks to a top-down approach with a macroeconomic and sectoral analysis to identify the highest potentials in the market, and also a bottom-up company evaluation, which is at the heart of our work on a daily basis. It is our DNA to be with this very specific philosophy named GARP, as I said, growth at reasonable price. We love usual winners and companies at the head of the economic dynamic in Japan. We are conviction-driven. We exploit market inefficiencies. And we are a lot of fund managers, 16 equity fund managers, all experts on the sectors, sharing their ideas. And we have two Japan experts managing Japan equity strategies for more than 20 years now. Both of them are speaking Japanese very well, are working with Japan equities and within Japan strategies for a long time now. And they are very consistent in terms of knowledge about the Japan cultural specific bias and also about the Japanese corporate companies. So let's have a look about our approach now. As I told you before, we could say that we have a very specific risk approach. We have a cautious approach with a low tracking error in order to monitor the risk on a daily basis with a low sectoral bias. You can see it below on the chart. Our objective is to provide an exposure to the Japan equities with this cautious approach, but providing a regular alpha. And we make it thanks to an agnostic approach in order to select the best stock market opportunities. And we are also focused on the future. We exploit non-consensual information to exploit market inefficiencies and to find good opportunities. How to make that? As I said, we have a top-down approach. We know very well the macro situation in Japan to exploit the good situation on a macroeconomic point of view. For example, the yen depreciation by 30% versus the USD for the last 3 years in order to select the best companies exposed to the export opportunities in Japan. But we have a conviction approach. We are bottom-up managers. In the context of the information provided and considering the dynamics of the Japanese market, as for us, a company will need to meet certain criteria to be considered for investment. These criteria are designed to capture both the growth potential and the risk mitigation in the evolving economic landscape. So in our process, we evaluate a lot of things to select the best opportunities. Here is a very traditional stock picking process from the ID generation, the fundamental analysis, the portfolio construction, and the portfolio monitoring. But to be crystal clear, we have a few factors we want to identify and we want to study before selecting our companies. First, we evaluate the corporate governance. Companies must demonstrate a robust corporate governance practice, including transparency, accountability, and shareholder rights. Then we evaluate the technological advancements and innovation in a company. For us, there is a priority for companies that are leaders or strong competitors in technological innovation. Then we are looking for solid financial health, of course, with a strong balance sheet, consistent revenue growth, and profitability. And after all, we are looking at the market position and the competitive advantage. A leading market position for us is very important, and the potential for long-term growth as well. We apply a sector diversification with low sectoral bias, as you've seen before. The aim is to represent various sectors to ensure the portfolio diversification to reduce the risk associated with sector-specific downturns. We are also focused on evaluating export-oriented performances for companies in export-driven sectors. We are looking for a strong global presence and performance, especially in technology and automobiles. And of course, we are evaluating the resilience in financial markets. We are looking for companies that show resilience in these very fluctuating financial markets. We are also focused on the future, as I told you before. The idea behind that is to create new investment ideas. How to know what will be the future performing companies in the Japan financial markets. As for us, we are here also to know the future mega trends that will be the main pillars of the Japanese economy tomorrow. So we have identified three main mega trends in Japan. First, the aging population, of course. Second, the production automation. And the last one, the surging Asian middle class. For each of these mega trends, we see future investment opportunities. As for us, these mega trends will lead the economic change in Japan in the next 30 years, so that we have to identify now which are the companies ready to create and start a transition within these new trends. This is how we create new investment ideas. You can see our main investment process, starting from the topics with more than 2,000 stocks in portfolio. At first, we are implementing a strong ESG exclusion filters with norm-based exclusions, and also a best-in-class filter based on ESG factors, excluding that around 400 stocks. And then we are starting to create our portfolio thanks to the identification of megatrends and the identification of investment opportunities through population aging, production automation, and the Asian middle class. And then we make our financial analysis and our stock picking process to create a strong monitored portfolio with around 100 stocks in portfolio. The objective of this strategy and this approach is, as I told you before, to provide an exposure to the Japan equity market with a low sectoral bias, a low tracking error, and to provide a regular alpha. So you could see here the behavior of our portfolio since for the last 5 years. In the meantime, we have to say that about our top-down approach, we have a clear view of the macroeconomic situation over there, so that we are monitoring all macroeconomic outlooks with the Bank of Japan, with the monetary policy, with the currency as well. We know that the yen situation is one of the main drivers of the performances in financial markets in Japan for the last 3 years, thanks to this depreciation. But we also know that it could be an opportunity for a portfolio to be exposed to the yen when the yen will be appreciating itself versus the USD. That's why we are offering both share classes in yen and in unhedged and in hedged version to allow our investor to be exposed to the yen when it needs to, anticipating a yen appreciation. But during the yen depreciation the last 3 years, offering an hedged share class for investors in order to be protected against any depreciation. I think that's time for me. I just respected my time. I will be very pleased to answer your questions if you have some.
Yes, Thomas, thank you very much for your interesting pitch, and we are going to move on and head over to Joel Ressource, working for Horizon Capital. Joel, looking forward to your pitch. The stage is yours.
Yeah. Hello, Paul. Thank you for letting me presenting some slides on Japan that Thomas did also previously, and thank you for the insight. Just to present myself, I am working at Horizon Capital. We are the largest asset manager in Italy, a subsidiary of Intesa Sanpaolo Bank, which is the largest bank in Italy. I've been doing Japanese equities for over 25 years, and the team of three that we manage 1.7 billion Japanese yen, 1.7 billion euros in Japanese equities, dedicated funds. Just to come back, and I will share my screen on some of the important topic for investors is beyond beyond all the positive on Japan. There's a lot of positives. Let's talk about market and market valuations. So you see on the left chart the valuation of the topics versus the top S&P 500 and the stock 600. We are currently, because those numbers are at the end of December, the topic is selling at 15 times PE. So it has basically reached valuation over a decade if you exclude COVID period. Historically, you can see also that it has been trading in line with European equities, and the premium is something that just happened over the last 6 months, basically. Thanks to strong earnings momentum on the right, you can see that the earnings momentum of Japanese equities is much more favorable versus the earnings momentum of Europe. It's been helped by the great yen weakness, to be honest. And just to remind everyone, when you buy Japanese equities, you buy over 2/3 of global activities. So it means that you buy just a third of what's going on in Japan. So that's why we do not focus much on Japanese GDP, Japanese macro, because it's mostly irrelevant for the Japanese market. But the level of the yen versus US dollar in particular is very important because Japanese companies are highly exposed to the US economy, especially the Japanese car makers such as Toyota. Obviously, the yen has weakened, as Thomas said, massively over the past few years, and but the Japanese market until recently, as you can see on this chart, hadn't followed, hadn't gained as much as the yen weakened, because Japanese companies are more international now, with more local production and less export versus the past. But obviously, a big topic is what next, because at the end of the day, a key factor to explain EPS growth these days has been the yen weakness. So in case of any yen strengthening, what would happen? If we take a very long view on the yen, we see here on this slide that the yen has moved along with the interest rate differential between Europe and Japan, but more importantly between the US and Japan. So it looks like the yen is at very attractive levels now. It's been at the weakest level in over 3 decades. And if we think few quarters ahead, and it's much expected by the market participant that the US Federal Reserve will reduce its interest rate. It will change in monetary policy, meaning that the rate differential, so the purple line you see on the right-hand chart, the rate differential will get smaller. which will likely drive a yen strengthening, or let's put it in another way, a weakening of the US dollar. This is very important because those benefited, and especially the largest market cap in Japan benefited, because the largest market cap are mostly international companies. They benefited a lot from the yen weakness. So if you have a yen strengthening, they will be victim of that. It's all that we see that that the valuations of the largest companies in Japan have increased considerably. The Topix 100, which is basically 2/3 of the market cap of Japanese listed companies, its price to book ratio has increased considerably. It's selling at now close to 1.6 price to book. So valuation are at a historical high since global financial crisis. So almost 15 years now. But you can see that the Topix 400, which are the large caps, as well as the Topix 500, small 500, which are mid caps, have not participated. As a matter of fact, this year alone, the Topix 100 gained 18%, when the Topix 400 and the Topix small 500 gained less than 10% each. So it means that those large companies benefited a lot from the yen weakness. The EPS, the earnings grew a lot, and market participants overall invested in those companies. The issue is that if we think that if you believe that the Federal Reserve will reduce its interest rate in coming quarters or months, which will probably strengthen the yen, then those large companies will be victim of yen strengthening. At the same time, it's quite likely that the Bank of Japan will remove its negative rate policy as early as next week, or 19th of March. Now the expectations are increasingly for a removal and ending of that policy sooner than later. Initially, it was expected that it would be April. Now market expectations are more for March, which will also contribute to a reducing rate differential between the Bank of Japan and the Federal Reserve rates, further fueling probably a strengthening of the yen. This is the same story with ECB, basically on the left-hand chart. So the ECB will also likely cut its rate, maybe not today, but in the coming months. So the rate differential will diminish, and it will make less attractive the carry trade that is occurring now, especially versus US dollar. So borrowing in yen and placing as a short term at 5% interest rate. So that's the reason for the yen weakness. It will also drive the insurance companies and the banks to repatriate some of the dollar investments. So the move of the yen could be quite dramatic versus the US dollar in particular. So if you would like to invest in Japanese equities these days, I think it would be more appropriate to focus on more domestic companies, especially at cheap, and there's a lot of room for them and for the valuation to increase. So that's our positioning now. We overweight in our strategy in domestic mid-cap companies that are cheap. We put a lot of focus on valuation in the way we invest in Japanese equities, and we consider carefully the valuation of each company in the portfolio. So with not momentum investors, we carefully watch the upside to the fair value of each company in the portfolio, and we also taking into account ESG risks, and our approach to ESG is to reduce the risk, especially the E risk, the environmental risk, which is great, and we could destroy a business model of any company. And please note that we do not have a best-in-class approach. That's our view. There's many things. You see here the numbers. I've been working with Yoko for over 10 years now, and Simeon, a younger person, has been with us for 5 years now. So we're well established. Simeon is in Japan this week. Which still goes to Japan at least once per year. So we're very much close to this market. In terms of fund, what I could add is sorry. That in terms of TSE policy, you see here that there's a lot of talks about the Tokyo Stock Exchange pushing companies with below 1x the book to do whatsoever to bring the price above the book. You can see here that on this slide we counted the number of companies with a price to book below 1, and you see obviously that among the TOPIX 100 companies, which is the dark blue line, there's few companies. Just 25 companies, like insurance companies, banks, and those companies will unlikely trade above the book. It's a structural, permanent situation when you can find a lot of opportunities in the TOPIX 400, the large companies, as well as the TOPIX 500. Is where you can do interesting stock selection, and you can invest in companies that could enhance the shareholder return policy to have higher than 1x price to book. It also said that what benefited from the Japanese market is that a lot of investors, including Chinese investors, capitulated on China. And this is very important because we saw a first wave of Chinese inflow in Japanese equities last May and June, and we saw a second wave this year. Apparently, we see also some Middle East sovereign wealth fund as well as hedge fund managers that play the Japanese market heavily. We haven't seen much of inflow coming from long-only traditional investors in Europe and in the US. We haven't also seen any inflow in Japanese equities from the Japanese retail investors because they just don't like Japanese equities and they prefer to invest in S&P. So this is unfortunate, but you should not count on domestic investor to buy more Japanese equities. I think that's all from my side.
Yes, Joel, thank you very much for your interesting insights. And we are going to move on, and I welcome Klaus Born working for Franklin Templeton, who is going to focus on two different markets. I'm really looking forward to your pitch, Klaus. Und auch gerne natürlich in Deutsch.
Ja, können wir gerne machen. Vielen
Yes,
Dank.
of course. We'll do that in German. I hope you can see my presentation on the screen. Wonderful. All right, so we've heard a lot about Japan. So now we will be talking about a couple other markets. Also in the emerging markets, as well as, well, if we take a look here, we often hear the question, is it India or China? And so I would just like to share some of my thoughts on that topic. I'm part of the emerging market team. Already been doing this for over 20 years. And I'm filled many different positions in this area. But first, I would like to start. Let's see. There we go. So let's start with India, from growth to returns. So there's been a lot of attention on India in the last few months, in the last year especially. So why shares from India? Why Indian shares? So it's the emerging market that's growing the fastest, and we have rates of over 7% that are very, very solid. And the expectations are, of course, accordingly. So what kind of trends do we see behind it? So we have increasing income. So in India, we are soon at a annual income per capita of $3,000. So what does it mean? So of course, if we're using our own measure, 3,000 annual income, of course, that doesn't seem like a lot. But India, if you're looking at purchase power, of course, there we're sitting here at the threshold that where the consumption really is increasing, that is higher than the base consumption. And we have a much, much higher purchasing power here. So what else has happened in India? We've had a lot of structural reforms. The administration has become much more efficient and has improved a lot. So now we've had a lot more investment volume. And of course, the infrastructure has expanded accordingly. So the digital transformation, we've of course have seen that in India as well. And we have the digital bank account access, digital transfers, digital transactions, digital payment transactions. And that's fairly new in India, that we now really have the broad population having the possibility to have access to this. So this makes the economy a lot more efficient. Then the last point, we have a higher valuation of the production sector. So there have been programs by the government to set up more production in India. And first an import level, but now also in exports, for instance, in cell phones, Apple, Samsung. And of course, India is profiting the trend that a lot of supply chains have shifted, and that would be an alternative to China as well. So now let's take a look at the biggest doubts or the perspective of the economy. So there's actually not a lot of doubt in this area with regard to growth, but the valuation in the stock market, that's where we can see some doubt there, that they're fairly high compared to other emerging markets and also some of the developed markets. So there's somewhat of a surcharge. So another area is where we have that high evaluation. In my opinion, we have three reasons. For one, we have a pretty high profitability in the Indian market. And so when we take a look at that on the average company, that's fairly high, and it has increased over the last few years. So that's one of the reasons why there's a higher valuation. Then, of course, we have the tendency that this is a little bit more solid than in other countries. So this does create some trust and some confidence. So, and at the end, the Indian stock exchange has a fairly high local participation. So it's not that strongly influenced by the outside. So we have an inflow into the market by Indian investors, often through that is not really speculative money that's flowing into that market on the Indian side, but this is often money that has a long-term investment goal and investment intention. So I would say we can take a look at the profits of the companies. That is, of course, one of the core drivers. And that looks pretty great. So we just have 10 years that were so. Those are behind us in the Indian market. Then the Indian market took off after COVID. And so we can also see that we have over 15% profit growth that we're expecting per year. So that's really pretty impressive. And this gives us a lot of hope on what we're seeing right now in the Indian stock market. And the density of the Indian market, so there's a lot of emerging markets where we also have a strong economic growth. But there, that didn't lead to any kind of gain in the stock market. That is different in India. So if we're looking here at the average growth in the market or on the BIP, so we can see how we have had an effect that is even greater than what we've seen in China. So there we've always seen a transformation in terms of share returns, but really it did not compare to how much the growth that has really made a difference in India. So we really can see that the economic growth has led to higher market returns, has improved the market. So this is a very interesting market for investors with a growth that we also can clearly see in the exchange. And so it makes it one of the most interesting markets among those emerging countries. Now let's take a look at China. So China, as we just saw in the past, China in the last 3 years has, of course, disappointed investors hugely in the last 3 years. So now the market has changed and is developing really well again. So, well, what should we think about the Chinese stock market? So we have somewhat of a summary here right now. Of course, we are seeing a very negative mood, but we were able to identify certain topics that are very interesting for investments in China. So first, that was summarized under the 5S in English. So now, of course, that doesn't quite work like that in German. So we have the S, supply chains. So there is a restructuring within China as well. Also, in part, there's the attempt to really serve the domestic markets and to build supply chains within that market. And there's, of course, companies that profit from that. Sustainability, the other S, also a very, very important topic in China. There's also a lot of government support for that. And I will show that in a minute. There's national supply chains are very strong. Services, those are also increasingly important, but there is a shift to a more consumption-based economy that's a little bit slower, or has happened a little bit slower than originally expected, but that is still a very, very important long-term trend. Then systems. So we have the innovations with software and systems and other IT systems. And there's, of course, very exciting companies to invest in. And then at the end, we have savings. The Chinese are very famous for being huge savers, and that, of course, increases the potential for the deployment and reinvestment of capital. And we have really great companies in this area that we can invest in. But now let's look a little bit more at two topics. For us, we've seen that it's really difficult to have that switch over to sustainable systems without having China to help. So a large part of the supply chains for solar energy is sitting in China, or other renewable energies, and also a lot of the demand. 30% of the production of solar modules is directly going to China. So in the short and medium term, it's very, very difficult to replace that. And so we can already see there's not really another place where this can be, where we can get this from, because the costs are just very, very high. And this entire ecosystem that has already been established. So that's very, very difficult to recreate that somewhere else, even if the US is trying to take another direction. We're relying on them. Then, of course, batteries are very important, especially for electric cars. And we can really see how strongly China is invested here and present here. And so we also, again, the demand is even higher than for solar energy. So 60% for electric vehicles, batteries for electric vehicles. The demand here of China itself is very, very strong, 60% almost. So the market share is strong. And that is just a really important sector for China. So overall, in the supply chain, we see really, really exciting companies that we can invest in. So one topic that is oftentimes considered somewhat of a disadvantage for China, the aging population. And we've already heard from the other presenters, also in Japan, that that is actually one of the core investment topics. And for us, if we are looking now at China, that is a potential that is really important, because if you're looking at the expenses in the area of health, you're sitting on the half of the world, or a little bit less, or half of Germany right now. So if we're looking at the aging population and the structure of the aging population, there's still a lot of growth potential. So, and also for the companies that are investing in healthcare. So our entire team last year, we were in China, and we actually visited a insurance company there who's shown us their concepts, how they would build services, build housing for that population. So we can find all kinds of companies like that in China. And then another really, really interesting aspect with regard to the Chinese market. So because of the pessimism that we've seen or that has built over the last few years, the valuation is pretty low. And so a really great foundation, if the right catalysts happen, then we can see somewhat of a rally again. So we've just seen somewhat of a rally, especially in February. And since I think if there's good messages or good developments coming, then we can see that this may continue. So in the end, a little summary, the most important items. So why India? It's the fastest growing emerging country in the next years. We see very positive long-term trends. We see the digital transformation, modernization of the production sector, and as we've seen, the market returns are going up. Then why China? We see a very attractive investment topics in an environment that's still somewhat negative in terms of the mood. We have this supply chains, the sustainability, services systems, and savings that are contributing. And what is really making the market interesting is the fact that the market valuations are below the long-term average. And so we're just waiting for just the right catalyst, and then we surely see a change in this trend. So in the very end, how can you invest in these topics? So here for India, that's the orange part here, it's the Franklin India Fund, which we've seen a lot of inflow right here. A team that's been there for a long time with an excellent track record. The alternative, not just India. Then we have the Templeton Asian Smaller Companies Fund, which overall is our entire network of our team is working on that and has a pretty high weighting of India right now. And they're doing stock picking in this area. Then we have two market segments that are covered by two funds, by the Franklin Sealand China Shares Fund that has the A share segment, stock picking in this area. It has a large experienced team on site that has been active since 2006 and has shown a lot of success in the long run and really has a very interesting could be very interesting for investors in Asia. Then we have the Templeton China Fund that's a little broader and invests in market leading companies. The focus here is really finding the right companies that are leading in the different sectors and are also listed for Chinese shares. So there we also have a strong team with a lot of knowledge of what is going on in the country and is integrated in our emerging markets platform. All right, that was it so far to the topics India and China. I will turn on my video again since I'm done and hopefully won't need that much bandwidth anymore. And I'm here to answer your questions. Thank you so much, Klaus.
To switch on their cameras so we can have a short Q&A for I would say 5 minutes time. Thomas, so the Japanese stocks have made also a blazing start to 2024. The Bank of Japan kept its ultra loose monetary policy 2023 unchanged. if they say, all right, we are going to shift the gears to normalize the monetary policy this year, what is going to happen with the stock market? Is the rally going to continue? Is the rally going to stop? Would be interesting to answer.
Well, I think on my standpoint, the rally will stop all of a sudden. Because a lot of, as I said, I mean, when you buy Japan, you buy over 2/3 of international companies, so companies that had benefited from the weak yen. On the other side, if you are exposed to domestic companies, the domestic companies who import a lot of things paid in US dollar, they will benefit. So you better off being positioned with long domestic companies versus the topics, basically.
Klaus, what might be also interesting that, of course, China shares haven't just a bad start to 2024. It's been also rough going since February 2021, so since more than 3 years. So are you expecting that China can really rebound in 2024, and or would you say there might be also other interesting alternatives? For example, investing in, I don't know, Taiwan. Is it also interesting, for example, to go for South Korea? Are these also interesting opportunities to invest in?
Ja, also muss ja sehen, letztes Jahr
Well, we have to take a look at last year. So we've already seen 2022, 2023, we had somewhat of a strong China rally. There was already some euphoria after the reopening, after COVID, of course. And so there is sort of the expectation that the consumers, there was somewhat of a disappointment that this didn't take as much as people had hoped. So, and that's why we saw somewhat of a downturn last year. But now we're really seeing that consumption is going up, and we see an improvement in China. Well, if we have really a regulation that are a little bit more specific. And so we think that this could really help rebuild the trust of the investors in the market. And that's not just international investors, but also Chinese investors who've really kind of held back for a while. So if we see that their trust is coming back, then I think that could be a really good sign for the market, and we can see an upswing in the market. So there are, of course, alternatives if we're looking for some exposure to China, neighboring countries, for instance, like Korea, who have been benefiting from certain development, or even countries like Brazil with fossil fuels, or with other resources that we're getting from there, that has, of course, experienced some positive market developments. So there are, of course, other countries that have a strong exposure to China than within those markets themselves, and that's, of course, not just limited.
Thomas, there are also different ways to invest in the Japanese stock market, for example, to go in a broad market index. Thomas, is it also interesting to really focus on the small caps stocks in Japan? Is it also, or do you also get a higher return if you go for the small caps in Japan? Or is it like the more easier, the more convenient way to invest in the caps in Japan?
Yes, Paul, thanks. I think that actually the video has been blocked for myself from your side because I can't put the video again. But I will answer your question. The fact is, small capitalizations are very important in Japan, of course, because in the topics with more than 2,000 stocks in the index, there is a huge exposure to middle and small capitalization. So of course, it's a very important factor for the Japanese market performance. The fact is, we know that most of large companies and large capitalizations in Japan are exposed to international business and of course trade, meaning that most of them are export-driven companies. It also means that these last 3 years, these companies were very exposed to the yen depreciations and their exports increasing, so that it supported their corporate profits and it supported their performances in the financial markets. But in the next months and in the next years, small capitalizations, which are of course less export-driven than the large capitalization, they still are very interesting. I mean that they are exposed to the corporate governance reforms to make them more profitable. They're exposed to these reforms to attract new investors, local one, but also foreign investors. They are very exposed to technology as well and to internal demand. So as the real growth is increasing, thanks to the wage increase this last month, the household consumption and the internal demand should increase and support small capitalization as well. So in a very yen depreciating macroeconomic situation, it's better for large capitalizations. But for the next years coming, thanks to the internal demand and thanks to reforms coming, the small capitalization should play a huge role as well.
Yeah, it might be going to be interesting for sure. I mean, we don't have much time left. I would say like about 3 minutes. I would ask you all of you three guys to answer the question, for which investor is your strategy, your fund being designed and aimed? Is it a more kind of conservative strategy or a strategy for higher risk investors? And is your product kind of more like classic basic investment or a satellite portfolio edition? And Klaus, you can also, of course, answer it for India and China as well. Thomas, would you like to start?
Yeah, thanks. To be very brief and to keep time for my colleagues, we are very cautious in terms of sector allocation, in terms of monitoring the tracking error. Our aim is to offer our investors a very cautious approach with a very wide portfolio, more than 100 stocks in portfolio, but creating and generating a regular alpha. Our objective is not to have an high tracking error and an high volatility. No, our objective is to provide the exposure to Japan equities and, of course, generating an alpha, but still monitoring the risk on a daily basis.
Joel, what about your fund?
Yes, I mean, monitoring the risk, but we focus much on the upside potential to the fair value. So we're not momentum players. We do not participate in momentum rally like we've seen since the beginning of the year. But half of our holdings are domestic companies, and we have a lot of mid caps in our portfolio. Those companies that will typically benefit from a yen strengthening that we're expecting very much over the next quarters. So the winners of today, which have been the mega cap exporters, international companies, will actually be the losers of the coming quarters.
Und das Schlusswort gehört dir, Klaus.
Danke. Ja, unsere Fonds.
And finally, you, Klaus, have the final word. Yeah, I think what we focus on are basically core investments in their asset classes rather than satellite investments. In all the funds that I have presented, We focus on the domestic market in China and in India, and that's where our investment focus is. And we are looking for companies which are less exposed to global changes, but more focused on domestic development. The same goes for our small cap portfolio. And I have seen that as a question about whether Japan is part of a particular emerging portfolio that we offer. It is not. It's only focused on the Asian market and not Japan. And that might be a good addition if you're already focusing on German investments.